The Fed says the days of high stock returns are over. And I absolutely agree with this explicitly. Well, explicitly, I don't know what the word is, but I absolutely agree with it 100%. So let's read this. This is Federal Reserve Board of Governors, and I'm not sure which one this is. I can't say. I guess just Federal Reserve. I'm not sure which bank it is, but maybe just the Federal Reserve as a whole. By Michael Smolensky. Who is this old Michael? Let's take a look at Michael as senior economist. Oh, look at him. Yeah, we got Michael. I'm just goofing you, Michael. You look like a good guy. He went to NYU, PhD in finance 2015. So a young guy. All right. Not that old, but it's a good article, man. So good on. Let's see what else he's written about here. All right, cool. At least going to go to Yale. We don't want anything from Yale anymore. The coming long term, yeah, right there. We're going to read that here. Does integrational mobility increase corporate profits? Well, lots of good stuff in here, man. All right. Ooh, which market indicators best forecast recessions? Ooh, to cut or not cut? Impact of tax cuts on employment income. All right, all right. Presentations, old Mike here. 2015, National Bureau of Economic Research. Oh, that's the University of North Carolina. Big deal there. Other activities. Part of the globalist cabal. Journal of Finance. I make myself laugh. All right, so let's take a look at this this article here, shall we? Hold on just a second. The coming long-run slowdown in corporate profit growth and stock returns. All right, so I just want to be clear. I could have titled this Dave Ramsey is wrong on future stock returns. You know, that gives you more when people, that's me punching up, and I don't do that often, if at all, frankly. I've done some videos on Dave Ramsey before, and I kind of get, I don't like using other people's names. It just, but it does give you more views, and then sometimes that works, but I try not to do that very often. I don't put a sexy lady on my thumbnail, nothing like that. I just, you know, I'm going to tell you the straight scoop. The issue here is that we have to remember how stock returns happen. They don't just, you don't just get 12% because historically that's what they've done. Stock returns are based on two things and two things only. They're not an equity risk premium. Give you 4% above the average bond rate. No, that's what happened after, not what caused the returns. So, oh my goodness, bonds gives us 6 and stocks have averaged 10. Thus, I should get a 4% equity risk premium. No. You're not getting. Anyway, so what causes growth in stocks? Earnings growth plus dividend yield. That is it. Earnings growth plus dividend yield. That is it, man. Earnings growth plus dividend yield historically give you roughly 10%. That's what we get. Stock bond returns roughly 6%. Thus, we have an equity risk premium of 4%. But that doesn't mean because bond returns give us 6, thus we increase our equity returns by 4. The equity returns are based on earnings growth and dividend yields. It has nothing to do with the bond returns. It has its own, I mean, it has something to do with interest rates and all that, but you can't look at these things as if that, then that. Stupid. And people do this all the time. Drives me up the wall. So what we're going to do instead is we're going to look at what is driving corporate profits. And we're not going to talk about dividends because dividends are what they are. It's like a bond yield. Dividends are about 2%. As companies start raising their dividends, that's wonderful. Will they, though? All right. I'm going to cut to the chase. We're going to go down here. I'll come back around. Anyway, so over the past 2 decades, the corporate profits of stock market listed firms have been substantially boosted by declining interest rates, expenses, and lower corporate taxes. This notes key finding that the reduction in interest and tax expenses is responsible for 1/3 of all profit growth for S&P 500 firms, non-financial firms. I argue the boost in corporate profits from lower interest and tax expenses is unlikely to continue. It's unlikely to continue. And indicating notably lower profit growth and thus stock returns. And here we go. Interest and tax expenses is a share of earnings. So you can see right here. Interest plus tax expense over earnings before interest and taxes. All right, so we can see it's dropping. Interest and tax expenses dropping almost a half. Almost a half since 2000. Corporate interest rates. Look at that. Huge drop. Corporate leverage. They're taking on debt. And basically, they're borrowing more at lower interest rates, and it's making them pay less in total borrowing costs. Those days are gone now, at least for right now. Effective corporate income tax rates, way down here. A drop of, again, almost a half. And that what did what? It went to the bottom line. And so here we're going to, well, this is kind of confusing, but basically what he's saying is, here's where we were 5.9% per annum per year is the growth of market capitalization, 6% a year essentially. If we took out that in terms of interest cost, the lower interest costs and the lower taxes, we'd be right here, 3.6% per annum. All right, so let's keep going here. So I want to cut to the chase. All right, hold on a second. Right here. What does this imply for stock returns? Over the past 2 decades, the market cap of the S&P 500 increased at almost 6%. That's in real terms. That's net of inflation. If corporate profit growth is expected to be substantially slower than the past, then such stock market performance can only be sustained by perpetual expansion of PE multiples. This is what Bogle talks about. You've got to get this book. I'm going to put a link in the show notes. Hold on a second. Get the book. It's almost 25 years old now. It's still just as relevant today as it was back then. Common Sense on Mutual Funds by John Bogle, RIP. Now, you can get this one too, Stocks for the Long Run by Jeremy Siegel. And he says, 100%, that's a good book to have. But let's not, people look at this and say, oh, stocks have averaged 10 to 12% a year, thus we can project 10 to 12% a year. Don't do that. Get the book. This will show you how. You can, look, I even got Bogle's signature. You don't. Get the book, because stocks are based on 2 things and 2 things only. Well, 3 things. All right, so let me go back to my chart. The stock returns are based on, there's 2 things and then a third, so it's really 3 things, but I'm going to share with you. Stock returns. We already talked about earnings growth year over year, EG plus DY, earnings growth plus year over year dividend yield. There's a third thing. It's called PE ratios. So basically what this guy, let me show you here, what this guy is saying. Perpetual expansion of PE multiples, i.e., are you willing to pay $20 for a stock that yields $1, or are you willing to pay $30 for a stock that yields $1? That's all that means. So perpetual expansion of PEs. And why was the stock rate so low in the 1980s? Because the PE ratios were 8. People were not willing to pay $20 for $1 of earnings in stocks. They were willing to pay $8 for $1 of earnings in stocks. I mean, you can't blame them. The 70s was a freaking crap show. You see what I'm saying? But that's what they're willing to do. And on top of that, you had bonds that are freaking yielding through the roof. So a competing entities called bonds, and stocks are like, huh? Again, if we look at the earnings risk premium, we'd have to say, well, if the earnings risk premium, where was it in the 1980s, guy? Because while the stock market took off, there certainly wasn't a 4% earnings risk premium in any given year. It's just happenstance, coincidence. So anyway, this right here is the only thing that would change if the earnings growth goes down. All right. Where's my blue pen? I just had it, man. Anyway, I like having 2 colors. That's weird. Literally just had it. So if earnings growth goes down, dividend yield stay flat. Actually, dividend yield will go up. Or dividend yield is based on price. Well, let's just say dividend yield stays flat. Earnings growth goes down. Dividend yield stays flat. What do you think is going to happen to PE ratio? Are people be more likely to pay more for $1 of earnings or less likely? Most likely they're going to be less likely. They say, that stock doesn't look so good. I'm not going to pay more. All right, so now earnings growth goes down, dividend yield stays flat, price to earnings ratios, what people are willing to pay for $1 of earnings goes down. What happens to stocks? They go down. And they will go down. Doesn't mean you're going bankrupt. It just means you need to expect much lower rates of return. Oh, that's exactly what I do in my right capital. That's exactly what I do. And let's keep going down here. And because no one's going to, the only saving grace would people be more willing to pay more for $1 of earnings. And when the interest rates are 1%, maybe, but now those days are gone, man. Anyway, so let's keep going here. Over the past decades, we are talking about it. Clearly, this is unsustainable. Perpetual expansion of PE ratios. If PE multiples were to remain at their current levels, then stock price could only grow at the same rate as profits, which would suggest a real growth rate of 3 to 3.5%, 100%. 100%. So 3 to 3.5% plus 2% dividend yield, that gives you 5 to 5.5. I'm showing a 4 to 4.5% earnings growth rate plus a 2% dividend yield gives us 6.5%. That even might be on the high end. I might need to revisit this. Actually, I'm actually more cautious than Vanguard is now. This remains a question whether PE multiples will tend to remain near their current levels on average over the long run, which are quite high. At the time of this writing, the forward PE ratio of the S&P 500 was 17. A value of 16 is essentially the historical median. And again, that's forward. All right, that always concerns me because it's only forward. It doesn't come to fruition until it shows up, i.e., do they actually make the money? It's possible that PE multiples in the future will fluctuate around the same historical median. On the other hand, if profit growth is slower than in the past, there's good reason that PE multiples average over time will themselves contract 100%. The reason for this is that the PE multiples embed expectations of future earnings. A reduced earnings growth rate means that the entire stream of future earnings will be lower. As a result, the stock price that investors are willing to pay per dollar of current earnings, the PE ratio, will also be lower. Yeah, this 100% could not agree more. The overall conclusion then is that with the expected slowdown in profit growth and the associated contraction in PE ratios, real long stock returns will be notably lower than in the past. And the funny thing is, what he doesn't say, he doesn't talk about higher expenses for labor. So you got higher costs for labor. You got higher, I mean, I don't even want to talk about taxes, but I mean, that could go up. It might, but higher costs for labor, higher interest expenses, you know what I'm saying? And you're going to have lower growth. And then never mind higher costs for energy. Let me show you something real quick. Dow Q3 profit halves on inflation energy cost. Halves. Cut in half on inflation and energy cost. So you have higher corporate borrowing costs, i.e. through interest rates, higher labor cost, i.e. inflation, higher energy cost. Where's the growth for stocks come from? I mean, again, I don't think stocks are going bankrupt. I just think you better prepare for lower growth, man. And as such, you should be more accommodating of looking at your bonds. And we'll go more into that here in just a second. All right, love your thoughts. We'll see you.